I am Zane, and I want to ask you one question before we start. If you could buy a piece of the most impressive engineering company on the planet, the one that catches rockets falling from space with mechanical arms like it is parallel parking, would you? Most people would say yes immediately, and that instinct is not wrong. The instinct to own a piece of something genuinely extraordinary is not the problem. The problem is what happens between that instinct and the moment you hit the buy button. Because somewhere in that gap, a machine that has been running for decades is waiting, and its entire purpose is to convert your genuine excitement into the worst entry price available. My name is Zane, and I have spent years studying why brilliant people lose money on companies they were completely right about. Not wrong about the company, right about the company, wrong about the price. And right now, with the biggest IPO in market history sitting in front of millions of retail investors who love what SpaceX represents, understanding the difference between those two things might be the most financially important conversation happening anywhere. So, before you open the app, before you hit buy, watch this first. What just happened and why the numbers matter? SpaceX just completed the largest initial public offering in the history of financial markets. Not the largest this year, the largest ever. It raised approximately $85 billion, shattering the previous record by nearly 3 times. The valuation placed on the company at the IPO price was approximately $1.77 trillion. That number put SpaceX on its first day as a public company among the 6 most valuable businesses in the entire United States, in the same tier as Apple, Microsoft, and Nvidia, companies that have been generating enormous profits for decades. And the stock did exactly what heavily hyped stocks do on opening day. It popped. Within the first days of trading, shares moved significantly above the IPO price, generating enormous returns for the people who received allocations at the original price. Those people were not you. Those people were the institutional investors, the funds, the banks, and the insiders who had relationships with the underwriters. The retail investor, the person refreshing the app, watching the ticker climb, feeling the pull of wanting to be part of something historic, bought at the top of that pop. Not at the IPO price, at the price after the excitement had already been priced in by people who moved faster and had better access. This is not an accident. This is the architecture of how public offerings work, and understanding it changes everything about how you should think about what just happened. The machine nobody explains. Here is the idea Zane wishes someone had explained to him before the first time he bought a hyped stock on day one. An IPO is not designed to give retail investors a good deal. An IPO is designed to give the people who already own the company the best possible price for selling a portion of it to the public. That is the entire event. The confetti, the countdown clock on financial television, the interviews with founders, the breathless coverage, all of it serves the same function. It creates maximum excitement at maximum price. The investment banks running the IPO are paid a percentage of what they raise. Their financial incentive is to raise as much as possible. Your financial interest is to pay as little as possible. These are not aligned. They are directly opposed. And one side of that opposition has been doing this professionally for decades, while the other side is refreshing an app on a Tuesday morning feeling like history is happening. History is happening. The question is, whose history? The mathematics of what you are actually buying. Zane wants to be precise here, because the numbers matter more than the narrative. At $1.77 trillion valuation, you are paying approximately 94 times SpaceX's annual revenue. Not 94 times earnings, 94 times the total money that comes through the door before a single cost is paid. For context, the most expensively valued major company in the S&P 500 before this IPO traded at around 73 times revenue. The average company in that index trades at approximately 3 times revenue. 3. SpaceX came public at 94 and traded higher after the opening pop. This valuation is not paying for the business SpaceX is today. It is paying for the business SpaceX might become if an extended series of optimistic assumptions all prove correct simultaneously. Starlink, the satellite internet division, needs to continue growing like a technology company with software margins. Starship, which has consumed enormous capital and still has significant commercial milestones ahead, needs to develop into a genuine revenue-generating business. New revenue streams need to emerge from the broader ecosystem. Government and commercial contracts need to expand. Every single one of those assumptions needs to land. If most of them land, but not all, the current valuation looks very different in hindsight. If the timeline for any of them extends by several years, the current price looks even more difficult to justify. This is not pessimism about the company. SpaceX may accomplish every one of those things and more. This is precision about what you are paying for on this specific morning at this specific price.
The artificial scarcity nobody mentions. Here is the mechanism that makes IPO pricing particularly dangerous for retail investors and that almost nobody explains clearly. SpaceX floated approximately 4% of the company in this offering. 4%. The remaining 96% stays locked up, held by insiders and early investors who cannot sell their shares immediately. Think about what that creates. An enormous global audience of people who want exposure to this company. An extremely small number of shares actually available to satisfy that demand. Basic economics does the rest. When demand is massive and supply is tiny, price goes up dramatically regardless of underlying value. The scarcity is real in the short term, but it is artificial in the sense that it was deliberately structured this way. The company chose how much to float. The company and its bankers chose to create maximum scarcity at maximum excitement. Then there is another mechanism layered on top of this one. Because SpaceX is so large, it automatically qualifies for inclusion in major stock indices. When a company joins an index, every fund that tracks that index is required to purchase shares, automatically, without discretion, at whatever the current price happens to be. Billions of dollars of forced buying flooding into an already constrained supply. This props the price up in the short term in a way that has nothing to do with the fundamental value of the business. It masks the reckoning rather than canceling it. Because the fundamentals do not disappear when an index fund is forced to buy. They simply wait. And fundamentals are extraordinarily patient. The locked shares are coming. There is a scheduled event in SpaceX's near future that the excitement cycle tends to skip over entirely: the lockup expiration. The 96% of shares currently held by insiders and early investors will not remain locked up forever. In waves over the coming months, those restrictions will lift, and the people who have been holding shares, often at prices dramatically below the current market price, will have the ability to sell. When a large new supply of shares enters a market, basic economics applies again in the opposite direction from before. Supply increases, demand stays roughly constant, price tends to decline. This is not a prediction. It is a pattern that has repeated consistently across IPO history. The artificial scarcity that helped drive the opening price higher gets unwound as the lockup releases more shares into circulation. The patient investor who watches this process, rather than participating in the opening excitement, frequently gets access to the same company at a meaningfully lower price. Not because the company deteriorated, because the excitement cooled and the supply picture normalized. A great company and a great stock at a given price on a given day are related, but they are not the same thing. You can be completely correct about the company and completely wrong about the price. Both statements can be simultaneously true. This has happened before with companies that were obviously excellent. One of the most widely known technology companies in the world went public to extraordinary fanfare and hype. The stock fell more than 50% in the months following the IPO. It did not recover to its IPO price for over a year. Was the company bad? No. It became one of the most valuable businesses ever created. Was the IPO price reasonable? No.
The excitement had priced in years of future growth that the stock then needed to grow into over time. The patient investor who waited approximately 15 months got the exact same company, the same technology, the same management, the same growth trajectory, for roughly half the price. The company did not change, the price came to its senses. Think about what that means for SpaceX. If you genuinely believe in what this company is building, if you believe Starlink will connect the world, that Starship will transform access to space, that the ecosystem Elon Musk is building has decades of growth ahead of it, then none of that changes if you wait 6 months. The rockets will still be landing on robotic chopsticks, the satellites will still be orbiting, the mission will still be intact. The only thing that might be different is the price you pay to own a piece of it. The governance problem nobody is talking about. Zane wants to raise one more dimension of this that most of the excitement-driven coverage is skipping entirely. When you buy SpaceX shares, you are not buying a proportional voice in the company. SpaceX has a dual-class share structure. The shares available to retail investors carry 1 vote each. The shares held by the founder carry 10 votes each. The combined effect is that one individual controls the overwhelming majority of voting power in the company while owning a smaller fraction of the actual equity. This is not inherently fatal. Many exceptional companies have been built under founder control structures, but it is information you deserve to have before you buy. You are not acquiring ownership in the conventional sense. You are acquiring financial exposure to an entity's strategic direction is controlled by a single individual whose attention is distributed across multiple significant organizations simultaneously. That concentration of control is part of what you are pricing when you pay 94 times revenue. What history actually shows about moments like this? Let me show you the base rate, not the best case, not the worst case.
What actually happens on average when retail investors pile into heavily hyped IPOs? Decades of academic research tracking thousands of public offerings consistently finds the same pattern. The most hyped, most expensive, most talked about IPOs tend to underperform the broader market over the years following their debut. The combination of sky-high expectations, artificial scarcity, and intense retail enthusiasm creates opening prices that are genuinely difficult to grow into. The companies often remain excellent. The stocks often disappoint, not because the business failed, but because the price required perfect execution over extended periods, and the market eventually demands evidence rather than potential. There are exceptions. Some IPOs deliver extraordinary long-term returns, even from expensive opening prices. But to capture those returns, you have to hold through the corrections that come along the way. And those corrections on hyped stocks can be brutal enough, 40, 50, 60% drawdowns that most retail investors exit exactly when they should be holding. The theoretical return and the actual return a human being captures from the same stock can be completely different numbers, because the theoretical return assumes you held through every scary moment. The actual return reflects what you actually did when your position was down 40% and every financial headline was telling you the company was in trouble. The permission you did not know you needed. Zane wants to give you something that took him years to fully internalize. You are allowed to love a company and not buy it today. You are allowed to believe completely in what SpaceX is building and still say, not yet, not at this price, not in this environment of maximum excitement and minimum supply. Conviction and patience are not opposites. The best investors combine them consistently. Watching is a position. Not yet is a strategy. The company will still exist in 6 months. The rockets will still be landing. The satellites will still be transmitting. The only thing that might change is the price. And if the price does not change, if SpaceX continues to grow into its valuation rapidly and the current price looks reasonable in hindsight, you will have missed a return. But you will not have been irrational. You will have applied a consistent discipline that protects you from the far more common outcome, paying maximum price at maximum excitement for a company whose stock needs years to catch up to what you paid for it. Drop a comment right now and tell me honestly, have you already bought SpaceX or are you waiting?
I want to know where this community stands on this one, because the answer will be interesting. What Zane actually does. Here is the practical framework. If you want SpaceX exposure right now and do not want to pay the day one tourist surcharge, consider this: a broad market index fund that tracks the S&P 500 or a total market index now includes SpaceX automatically as a result of its index inclusion. You already own a proportional slice of this company if you hold one of those funds. You got the exposure without paying the opening day premium. You let the index mechanism do what it does without requiring you to time anything. If you want direct exposure specifically, consider waiting for the lockup expiration windows when additional share supply hits the market and the artificial scarcity dynamic eases. Watch the price during those periods rather than during the maximum excitement of the IPO window. The company will still be there, the mission will still be intact, and you may find a considerably more rational entry point than the one the opening day excitement produced. There is no trophy for buying first. There is no medal for owning a stock on its most expensive day. The prize in investing goes to the person who is still standing, still calm, still buying good things at fair prices, long after everyone else has moved on to the next exciting announcement. The confetti will be swept up. The countdown clock will move on to the next event. The financial television coverage will find a new story, and SpaceX will still be there, building extraordinary things, landing rockets, connecting the world with satellite internet, planning missions to Mars. All of that will still be true. The only question is what price you paid to own a piece of it. Get that part right, and the rest takes care of itself. Get that part wrong, and even being right about the company will not save you from years of waiting for the stock to catch up to your entry price. Be the investor who can tell the difference. If this helped you think more clearly about what's happening right now, hit the like button and subscribe to Wetrix Invest, because next time we're going even deeper into the mechanics of how markets price excitement versus reality. And that's a conversation that will make you a better investor for the rest of your life.